Yeah, good morning in Europe and Germany. Good afternoon in Asia and China. My name is Horst Löchel. I'm in charge of the Sino-German Center here at Frankfurt School of Finance and Management. Most of you know that. And we are together today for our next webinar, the first one actually after the summer break. You know from the invitation, the topic is the development and future of Chinese CVC industry. And of course, this is a very hot issue, even the domestic as well as the international development. Today, I'm here together with Professor Boris Bauke from the University of Applied Science, Aschaffenburg. Boris is a professor of digital and entrepreneurship, digitalization and entrepreneurship, and in charge of the AI transfer hub of the university in Aschaffenburg. We have also two distinguished speakers today, actually from the industry, Dr. Min Zhou and Dr. Hongquan Jiang. Welcome. Boris will introduce you in more detail in a second. Actually, this webinar has a background, and the background is that the University of Applied Science in Aschaffenburg and the Frankfurt School of Finance and Management, I think now for 3 years or even more, running a project on behalf of the German Federal Ministry of Education and Research called CVC as a tool for innovation in China. And the background is, of course, that the German government want to learn something, how to steer, how to foster, how to support innovative processes via venture capital or corporate venture capital in the economy. I hand over now in a second to Boris Bauke. Let me say the procedure as always. We have the introduction, the keynotes, 15 minutes each from our experts here. After that, we have a Q&A session. Please note, we will record the statements, but not record the Q&A session, so feel free for our question. Having said that, I hand over to Boris Bauke. So, Boris, the floor is yours, please.
Thank you very much, and thank you to all our participants so far and the two speakers. As you already alluded to, our overarching idea for this webinar was the current state, but also the shifting environment for corporate venture capital in China. And while there is surely, if you look around in the world, many signals for pessimism and discouraging signals in international commerce and relations, we probably all know that more difficult times also can lead to great opportunities. And we think corporate venture capital in China might be one of them. And especially in the deep tech area, because certain actors are exiting the market, some of them for regulatory purposes, meaning less competition for attractive deals, and also an ever-increasing B2B industrial deep tech focus of the Chinese government, meaning great tailwinds also on the local government level. And we have, as you already said, two amazing speakers that might be able to allude to those topics due to their longstanding practical experience, not just in deep tech, venture capital and corporate venture capital, but also bridging the gap between international markets and China. And I will briefly introduce the two speakers in the order that they will give their 15-minute impulse presentations. And after that, we can dive into the Q&A. The first speaker is Dr. Min Zhou. Min Zhou is founder and CEO of CM Venture Capital, which is a Shanghai-based venture fund focused on deep tech topics like new materials, advanced manufacturing, digital industry, energy, and environment. Interesting part is that the limited partners or the investors in the fund are large international companies like GE, Samsung, BASF, Heraeus, Petronas, and others. So she's also bridging the gap between international interest in China and local investment opportunities. She has done plenty of deep tech investments in China since launching the fund in 2012. Before that, she had 6 years of investment experience in the US with corporate VC unit of Unilever, where she led also physical science investments and some experience with the Silicon Valley Bank in the fund-of-fund investments business. Min is a scientist by training and holds a PhD in material science and engineering from University of Southern California, and she also earned an MBA from UCLA and a BSc in material science from Tsinghua University in Beijing. Min will be followed by Dr. Hongquan Jiang. Hongquan is an investment partner at Robert Bosch Venture Capital in Germany, but more recently is one of the lead architects and the managing partner of Boyuan Capital, which is Bosch's investment platform in China. And he will also talk a little bit about that platform and where it is similar or the same as Robert Bosch Venture Capital and where it differs. He has a very long-standing deep tech investor track record with investments in areas such as IoT, artificial intelligence, augmented reality, and automotive in Europe, China, and the US. At Robert Bosch, he is responsible for the search cluster automation and electrification, which includes topics like sensors, semiconductors, electronics, robotics, autonomous systems, and such like. He has been with Robert Bosch for a very long time, 1969, if I'm not mistaken. So he knows the company well, he knows the technologies well, and he also received a diploma as well as his PhD from the Technical University in Berlin. So he's also very well versed on the practical and theoretical side in Europe, Germany, as well as in China. And with that said, I would open the floor and hand it over to you, Min. Maybe you could start with your impulse and talk a little bit for us.
Yeah, sure. Thank you, Horst and Boris, for inviting me to be a co-panelist with Dr. Jiang here. Certainly happy to contribute to the topic of CVC in China. I think most audience probably not familiar with CM Venture Capital since we are not as well known as Bosch. So maybe I will give first bring up a few slides to quickly walk through CM Venture. Yeah, so can you see the screen?
Yes.
Yeah, you can see the screen. Okay, great. Yeah, let me quickly run through CM Venture Capital so the audience know who we are and what we do. So quickly, yeah, we started in 2010. And as Horst mentioned, I moved back from the US to China in 2010. I was investing in the materials and hard tech in the US already, but found really time is very long and cost is very high. So thought to basically wanted to explore if we can do the hard science investing by combining the best of East and West. So we moved back to China. I started as a CM Venture in 2010, and we started our first fund in 2012, second fund in 2016, and the third fund in 2021. And now we are basically launching our fourth fund, which is the Evergreen Fund. So what we do is we invest early stage. So as a scientist by background, by training, we love science and we love tech. So we invest early, usually 1 to 2 years ahead of the market. We're tech savvy, and that's I think it's critical to be tech savvy, in fact, investing in hard tech. And we have a global standard and perspective. So we invest primarily in 4 areas. One is decarbonization, and that's primarily in CO2 utilization. We have led investment in UK-based Econic, US-based Noble Nutrients. Those are all CO2 to material kind deals. And the second part is energy transformation. We have done major investments in hydrogen and bioenergy. So our investment here in Guofu Hydrogen, the last one on this screen, is going public in Hong Kong Stock Exchange next month, which is very exciting. And we have been investing in hydrogen basically since 2019 in Guofu, and then subsequently we have done 2 more investments in hydrogen. And then a lot of our investments in material transformation. As Horst introduced, my technical background is material science, and my partner, two partners also are in material science background. So we have done quite a bit in material transformation, what we call new materials, new processes. And then the last piece is digital transformation, which is into digital industrial, autonomous driving, and most recently AI plus. So we have done our first AI plus materials investment this year. So we have roughly invested around $90 million in 26 tech startups to date. So as you can see, so we are early stage investing. So we start with a few $1 million in a company, and we can invest up to 10 in our top performing companies. The companies total have a market cap of over $3 billion now. And we are proud to say all our portfolio companies contribute to more than 2,000 employees since. And since we started our investment, 1/3 is in seed stage and above. So when we invest, they have few employees, no revenue. And so it's really great to see how these companies grow. So my background was introduced by Horst. I have 3 other partners, and we are very international. Dr. Patrick Bourbon is a French scientist. Michelle Hua is Chinese, and we are the 3 of us. We actually all graduated from Tsinghua University, and Xavier here is Singaporean and worked in communication and in Huawei, and lots of marketing background. So this slide basically summarizes what we do. We are very global. We have international LPs like the corporates here, and we are adding more corporates to our evergreen fund. We have investments so far 70% in China, 30% abroad. With our evergreen fund, we will be doing 50% abroad and 50% in China. But even for those investments we have made in US and Europe, we do help the companies to partner with Chinese public companies to quickly scale up and cost down. Because we believe it's very critical for the physical science companies to quickly scale up and therefore bring the cost down to be competitive in the market. So our investments in US and Europe are not 100% US-Europe, but we play the bridging role to bridge them to the China market. We have a we have 4-step process, what we call brand process. First step is predict. Second is select, build, and partner. Predict is really about thought leadership. We do publish quite a bit in and sharing our thoughts on different industries, like SynBio or the changing face of MNC in China. We have started a column at Global Corporate Venture, gcv.com, featuring Chinese innovation. So I encourage everyone who is interested to follow our column. We have a quarterly write-up. And then we have selection criteria, which I believe is the most important one, maybe is the inflection point. Although we invest early, we want to invest at the inflection point for technology maturity and market takeoff. So you don't want to invest too early. So that's probably the most significant selection criteria. That takes a lot of experience to be able to basically have the right time for the inflection point. And then we take significant position. Like, for example, in the growth for hydrogen case, by the time the company goes public, we are still their largest institutional investor. We are the 3rd largest shareholder in growth for hydrogen. We have other, basically in all our investments, we are typically number 1 or number 2 institutional investor in shareholding position in the company. We invest in industry leaders and disruptors. So it's clear becomes the number 1 position in the industries that we invest in. And open entrepreneurship is really about working with the MNC. So we have a database of now 7,000 startups, and we actually do share with our LPs. And that's one way that we work closely with our limited partners, corporate CVCs. And then this build part, we have really focus on 4 areas. The first one is the strategy. We're always on the company boards. So the most important thing to do for our companies on the strategy, which to us is really what do you do and what you do not do, which is the focus of the company. And then we help with biz dev, fundraising, marketing, which Xavier, our marketing director and partners, spend a lot of time on. And then there's leadership change or leadership recruitment and optimization. So those are the areas we build. And then the finally partner, including with our MNC LPs, as well as the MNC companies who we work with. We do a lot of events, including open innovation workshops with limited partners. And we also do annual conferences, like we just did Innovation China did one in April 2024, focused on AI plus industrial. And we are having one in November for renewable carbon. So anyone coming to Shanghai in November, you are very welcome to join us for our Innovation China conference, where you will network a lot with MNCs as well as the startups. So basically why we call ourselves Carbon Mitigation Evergreen Fund is because if you look at the areas we invest in CO2 utilization or DX or EX or material transformation, say one way or another, they all contribute to carbon reduction or scope 1, 2, and 3 in terms of for the in the areas that they address. That's why we are starting this new fund, which is the Evergreen Fund. We're starting probably set up launching in November. The idea is basically to continue to do what we do in materials transformation, digital transformation, energy, and carbon utilization, finding those good solutions that MNCs can leverage to to reach their carbon emission reduction goal. And so it's a win-win-win partnership. Yeah. So that's a quick introduction about our fund.
Thank you very much. And we would hand over to Dr. Jiang, talking about Robert Bosch and Boyuan Capital. Thank you.
Okay, thank you, Boris, and also thank you, Horst and Boris, for inviting me to today's roundtable. So over the next 15 minutes, I'm very honored to be able to share some of my perspectives. So I would like upfront to send 2 messages. So if you would forget everything that I'm going to say, I hope that you can remember these 2 messages. So first, so the Chinese CVCs have played and will continue to play a significant and at times a dominant role in the venture capital market in China. So this might be one of the major differences compared to Western countries. And second, there will be still huge opportunities for Western foreign investors to engage with Chinese VC and PE market. Okay, having said that, let me briefly talk about Bosch's corporate venture capital activities. So I assume everybody of you know the Bosch Group, so no need to say too much about that. So the Bosch Group has founded its corporate VC arm called Bosch Ventures in 2007. So Bosch Ventures operates globally and entered Chinese market in 2015. We are a traditional CVC investing around the business field of Bosch Group. We also have offices in US, East Coast, West Coast, 2 offices in Europe, and also 1 office in Israel. So in 2021, we established another investment platform called Boyuan Capital in China. So which I am heading this organization. Boyuan Capital currently is managing two main funds in Chinese local currency, so RMB funds. So, and we also raise external capital. And we hold a private equity fund management license in China. This is a quite rare achievement among the foreign CVCs in China. So I'm not aware of any other foreign industry corporation having such license. So you can see that we have doubled down on investing in China because of its strategic importance to our business and its long-term growth potential. So our investment focus includes the automotive, new energy, industry 4.0, and foundation such as AI and semiconductor. Currently, Boyuan Capital, we focus on growth stage investment. So now let's talk a little bit about the development and transformation of CVCs in China. Maybe let's look back to the early 2000s, which was the beginning of Chinese CVC and also the VC industry. At that time, Silicon Valley VCs just entered China, and the US dollar denominated funds were pioneers in the Chinese VC industry. So around the same time, China quickly developed its own CVC ecosystem. So I think Legend Capital, so the Legend was a laptop vendor today. Legend Capital was founded in 2001. This might be one of the first CVCs in China, but followed by major players like Baidu, Alibaba, and Tencent. So these internet giants become key players in the early Chinese VC scene. So international companies such as Siemens, BASF, Intel also established its branches in China. However, for the first 10 to 15 years, Chinese internet CVC players played a far more decisive role in the VC industry than their Western counterparts. So over time, CVCs, especially the internet company-backed CVCs, become the ultimate deal maker and acquirer of the startups. So some examples: the creation of Didi Taxi. So Didi is the equivalent of Uber in China. So this would showcase the power of internet CVC in China at that time. So it was a battle of so-called Tencent camp fighting against Alibaba camp. So both Tencent and Alibaba wanted to dominate the online taxi market. And on top of that, they also would like to control, with this investment, the mobile payment market. So Tencent backed the company Didi, and Alibaba backed the company Kuaidi. So the war for market share costed billions. So it ended with a merger of the two companies. This settlement created the Chinese online taxi marketplace monopolist, which is Didi. So nowadays there are other players, but at that time it was definitively the monopolist. So we can tell a very similar story immediately after that for the rental bike battle. So for that, at least 5 to 6 CVCs will participate in different bike rental companies. So a unicorn called Ofo was created within 6 months after funding, with massive support by investors. So no company in this area could survive without a strong internet CVC support. So these deals marked the peak of the first phase of Chinese CVC dominance. So then the first major shift occurred. So in Chinese VC market, I would say it's around 2015-16. So as investment transitioned from internet, mobile, and e-commerce to manufacturing and high-tech industry, the era of business model innovation was ending, and the rise of high-tech industry began. So the key milestones marking these shifts was the founding of new energy vehicle brands like NIO, Xpeng, and Li Autos, all venture-backed companies. Unlike the internet, in the internet era, deep industry knowledge and network from the different type of investors become essential for such kind of investment. So in recent years, CVCs like CATL, so CATL is the giant lithium-ion battery manufacturer. So they're controlling a huge market share in lithium-ion battery. So they become large players in CVC market. Xiaomi, BYD, these companies took the lead, while the influence of internet CVCs dramatically declined. So we witnessed a generational change in this industry. But then very quickly, several years later, we have another major shift, which was the US-China contest. And with that, actually the decline of the dollar-based VCs in China. So the escalating competition between US and China has strongly impacted the capital flow. As a result, so US dollar-based limited partners have been pulling out of China due to the regulatory restrictions. So it becomes increasingly difficult to raise dollar funds. And GPs, so general partners of US dollar funds, are restricted from investing in cutting-edge Chinese companies. So for some critical domain like AI and semiconductor. But to be clear, so these restrictions are mostly caused by the US side. So additionally, IPOs in the US have become more problematic for Chinese companies. So altogether, this had led to a rapid decline in dollar-based VC in China. So dollar funds raised for Chinese markets dropped by 65% within 2 years in 2023, for example. Major US VCs like GGV, Sequoia, they restructured their fund, often splitting the entities to separate entities just to maintain their operation in China. So some of the US dollar funds are returning their money back to their investors. So after this dramatic change, today, the Chinese VC landscape is dominated on the one hand by the state-owned funds. Last year, 2/3 of the funds raised in China come from a government entity or state-owned enterprises. So this year, GPs sourcing money from government entities increased more than 4-fold compared to the previous year. On the other hand, besides the state-owned investors, CVC as another major force in the Chinese market. So CVCs become one of the 2 major players or major categories in the market. So so the motivation of the corporate is using their CVC arm to invest along their supply chain to build ecosystems. And this become a very popular and essential part of their business strategy. On the other hand, this is also very much well perceived by startups. So the hottest investment area in the last, I would say, 8 years in China was automotive, semiconductor, and renewable energies. So I think this is also very unique compared to the Western markets. And CVCs are increasingly involved in the so-called insider deals, where startups raise funds from CVCs before approaching traditional VCs or state-owned funds. So this arrangement gives CVCs a great level of power in the Chinese market. So this dynamic has not been seen in the US or Europe. So looking forward in the future, so let's talk about a little bit about the future of Chinese CVCs. So let's try to answer the question, what will drive the next phase of CVC development? And can European CVCs succeed in China? So my observation is, so a very important rationale for CVCs investing in China in the future will be the mega trends of restructuring and securing of supply chains. So shorter product cycles, cost-cutting pressure, and the need to localize supply chain will fuel investment by CVCs. And this restructuring will also extend to global supply chain. So this is actually happening now and in the years to come. So Chinese companies are increasingly focusing on regional expansions, so into Europe, Southeast Asia, Middle East, and even Africa. So this strategy will open for CVCs investment opportunity in the global market, so really on the global scale. Here, the European companies and investors could play a significant role. So I personally believe that this could be a huge opportunity for the Western investors, also for us, because we are really talking about no less than the transforming and rebuilding of the industrial base worldwide. So this is a huge opportunity. So finally, let's talk about technology. So we are tech investors, right? So which role will technology play in the future? So I think a big topic is AI. So AI is poised to become the next major investment opportunity also for CVCs. So we are now moving into the, I would say, AI 2.0 era. As AI continues to revolutionize industries, CVC are likely to be the preferred partner for AI startups, so helping them to build domain-specific AI applications, so and accelerating the technological transformation. So these are my 2 cents. So thank you for your attention.